Hello everyone, welcome to Smart Investing. So I'm Albert, as you all know, and today this video is going to be about the continuation of the banking services sector. Again, the stocks are not in a particular order. They're not in order by market cap. They're not in order by price or anything. The stocks are just randomly put for this video. But again, as time goes on, maybe in a few years, when I do finish all these sectors and I get back to doing the sector and actually reevaluating it and to see which companies down the line, even a few years from now, to see if they're any good, which ones are still doing good, which ones are doing bad, and which ones are still like hanging in there, if they're existing or not, or growing or not. So just a basic evaluation in the future. So along with that, I most likely I've been thinking about actually using a different metric. I know that I've used PE ratio a lot. I'm so used to it. It is good to use other metrics to evaluate companies, especially for the financials and the industrial sectors. And usually they use a different metric. I believe they like to use price to sales, because the way their debt is implemented, they get to use it differently. It's just so much to explain and harder to explain all that information, but they use debt differently. And what I'm trying to say is, it's more common for them to use debt because they rely on debt. For example, with loans and stuff like that, all these banks, they rely on people to pretty much take out debt and take out loans. So that's the core of their business. They rely on other people to pay interest payments, big or small, and some places require certain credit scores, some do not. And it varies. It could be for a car loan, it could be something as small as like furniture, or like a refrigerator, certain appliances. I've seen actually when I actually purchased my phone, they wanted to do like payment plans as well, and it's crazy. Like, it's crazy to say, but even the smallest items, like, you know, whether it's even a few $100s, nowadays it's like, people take out loans for, low, very low amounts. To me, it's mind boggling. I'd rather just save the money and pay it off at once. But, in general, big payments are usually for a house or a car. Sometimes it can be tricky when it comes to appliances or furniture. That can range, let's say around really good furniture, let's say, and also appliances. Let's say a few $1,000s, $5,000, $6,000. The average person can afford that. And basically they take out payments, which is understandable, even without a down payment. So what I'm saying is that people, tend to take out debt pretty much. And whether they do put a down payment or not, either way, people just rely on debt more than equity. And people that do have equity, it's because they have everything paid off, have really good jobs and stuff. And then also, they people that own businesses. I mean, like small companies, big companies, have been buying out certain properties and all that for bank loans. So anyways, let's move on. Let's continue the banking services sector. I'm blabbing too much, but I just thought I'd throw that out there. So again, before I start, I'm not an official financial advisor. If you're going to invest in the stock market, please consult somebody who's licensed and insured. I am not licensed and insured. So any information that I provide is for informational purposes only. And again, I want to thank everybody for providing the viewership and support and help as needed for my channel and my skill set, and for everyone, thanking everyone again for believing in me and what I can do and what I can provide, and also the information that I can give out. So with that said, let's move on to these stocks. Again, I have about 11 stocks, so we're going to start from the bottom up like always. So first one up I have is TD. And again, I apologize in advance. If I did go over these stocks, I'm going over them again. I have my stocks on my phone, and they're not written down. I have them taken as pictures. So I have about like 80 pictures, and it is so hard to keep track of which stocks I did and which I did and didn't do, if that makes any sense, because there's times where I try to go to the full list and do the whole picture, and it's a small list. There's other pictures and other stocks that I have written down where the list is not short. So maybe down the line I'll reorganize it better, and I'll do it like 10 by 10, even though it takes longer with more pictures. But it's just a lot of stocks to keep track of, and again, I apologize with that. Maybe I can find a better way to evaluate the banking sector. And again, new banks get acquired or go bankrupt. So this is why I want to continue doing the banking sector, because there's so many companies, and then you can actually see what happened throughout the time. So this is a good this is a good channel to keep a track record, and also to keep a stock list of which stocks do good and which do bad, which went bankrupt and which are growing and still around. So let's begin. Let's do TD. I believe I've done it. I'm not certain, but I believe I've done it. So Toronto Dominion. This is a Canadian bank. So let's look at the numbers, which I love to look at. Most importantly, fundamentally and technically. Right away, I see that there are a market cap of 139, rounded off to 140. Active stock looks pretty good. PE ratio seems to me that it is undervalued. Price to sales, I don't know what is a generalized number. So with the PE ratio, if I already said if it's undervalued, I'm taking it as 4. The number 4. Well, I know price to book. Anything under 3 is pretty good. But price to sales, I'm not familiar with it, to be honest. So that is something I have to learn and grow from. So yeah, I have to learn new metrics, and please join me on that journey while we learn together and experience a new form of strategies and experiences. Everything is a learning process, and it is always good to learn. So Toronto Dominion, let's look at the earnings real quick. So I have earnings per share 6.27, which is pretty good. Again, I'm expecting the debt to be above 85%. If you've seen my other videos, it's pretty obvious. They've done 85% debt typically on banks. If they're not a bank, they're closely related to it. When it comes to the sector, they're either doing consumer lending or such similar activity. So dividend yield, I'm not too crazy about. I don't really look at that. I like to look at total. So let's look at that total. So moving on from that, definitely active stock. I don't think it's too pricey. People can debate me on that. It's close to $77. I don't think that's an expensive stock. according to the 2020 numbers all the way to 2022, there have been a bunch of stocks the past 2 years that have been very, very expensive and very overpriced and overvalued. So looking at that price, just thinking about it, I don't think it's too expensive, and it's not too cheap either. So we look at the 52-week range. 52-week low of 62, 52-week high of 86. That is a difference of, for the year, about $24. So you're looking at about $2 a month. That is not bad at all. Could be better, but it's okay. I would say it could be much better for a company of that size. But let's look at the dividends. They have been raising dividends, as you can see. In 2022, these are the numbers. So we have here 89 cents for the Canadian dollar. So then we have in 2021, 79 cents. In 2020, we have another set of, it looks like about 20, oh, sorry. In 2020, it looks like it's a payout of 79 cents. But this first payout here in 2020 was 74 cents. So it grew 5 cents. And basically from 2020 to 2021, you have a difference of pretty much, it stayed the same. For the most part, it stayed the same. I'm sorry for my drawings and stuff. That's the best I can do. And again, since I'm on my phone. So let's look at the splits. They have done a split. The last time was in 2014, 2-for-1 split. I'm not too crazy about that. Let's look at the annual numbers. Good. I do have 2021 numbers. So let's look at that. Let's scroll down real quick. Debt is 94%, 0.23%. Now let's look at the deep dive on this. So these are the estimates here. Estimates are here in the gray circles. So it looks like for the most of 2021, they have beaten the expectations. But as you can see, if I was to draw a straight line as to how many points were touched for that year, we're looking at about 1.58 or 1.57. So we can see they beat that benchmark. And let's look at the return on equity, 14%. Let's look at the ROA. So it's about the same. EPS has grown a little bit. So that is a gain of about 18%. I was going to say 8, but yeah, it's about 18%. But then in 2017, it went from 17 to a gain of 9%. But the total number, it went from 5.5 to 6. So they gained a lot from 2020 to 2021, excuse me. We have here net income has been flat for pretty much almost the last 5 years. And so in 2021, they have grown 35% of net income. Now we have here revenue slowly growing, which is good. Operating income, I don't have anything. And cash flow, they have coverage for cash flow. So it looks like a good company. It looks like they can cover the dividend. And it looks pretty active. Very strong market cap. Especially for, I mean, comparing to everybody, to all these banks. And the dividends, they paused again. They paused in 2020 and 2021. Only concern is that split. They had two. Let's look at that again. Because they had splits in 89, 99, and 2014. So, that's a pretty big gap. So at least 10 years for the last. Sorry, for the first two splits, it was a gap of 10 years. Then from that, it's been about almost 10. So TD, what I'll say about TD, I give it a watch list. Seems like an okay watch list. Next up, Tbnk, Territorial Bancorp. So we have here, wow, what a drop in March. What a drop in March. We have here a difference of the 52-week high and 52-week low. We have a difference of about $4. Not really much. If you want capital gains, this is not a stock for you. If you want it because of the dividends, I would say find another stock. As we can see here, they do pay special dividends. But again, it's just not worth, I don't believe it's not worth buying for just to get the special dividend or the stock. As we can see here, it doesn't show, it's not showing me the payment, the amount for the special dividend. So again, I'm going to say no to this one just by looking at the numbers. Let's look at any other given year if they have even done any good. So real quick, let's see. So they are a bank. They are in the banking services. And we have here, excuse me. So we have here the last 5 years. And again, we have here at most around the $30 range or high 20s. And in the 5 years, we're looking at about a $5 difference. So that's not really good. So we also look at the market cap, 215 million. It doesn't seem like, I mean, by revenue and everything, they might have grown, but it's just people just don't like this stock, so it hasn't grown. So I'm going to have to say no to this one and move on to the next one. Next one up that we have is STXB, the Spirit of Texas. We have here earnings per share at a 2.3, 52-week high and low, a difference of about $10. Looks to me that it's undervalued. Pretty popular stock. Okay, so it's active, or it has been active lately, or I could be wrong, could have been months prior. But from what I'm seeing, it's an active stock. So now let's look at the dividend payments. So you can see here, it looks like they just started paying dividends. So ever since 2020, and then 2021, they made 5 payments. And within that 5-time payment, they actually grew the dividend 3 cents. So we're looking at a 3-cent raise. And in 2020, it was a 2-cent raise. So it looks like they're raising the dividend pretty consistently every year. Obviously, if they started doing dividends, so I wouldn't think they would start doing splits. That would be the wrong move. If it looks like they're starting to grow and actually even pay dividends, a lot of companies love that. I know I do. So let's look at their annual report. So we have here a net income of 42 million, revenue of 128 million. So now let's look at their debt real quick. 87, so that's pretty typical for a bank. So it looks like they have beaten earnings estimates. So far, so good. Return on equity has been growing. Return on assets have been growing. Earnings per share has grown tremendously from 2020 to 2021. Book value has slightly grown, and it has grown close to 8%, as you can see here. So it's grown close to about 8%. And let's look at their margins. Hopefully we have it, and we don't. Debt is pretty typical. Debt has remained the same, as you can see, which is fairly good. I mean, it's already high as it is, so you wouldn't want any more. Cash reserve and cash flow. Net income. Wow. The net income has grown tremendously. You can see here from 2020 and 2021. That is a big jump. So we're talking about 34%. Now revenue, I would assume, has grown. And it has grown slightly. So we're talking about from 124 to 128. So it's only a $4 million difference. But year over year, we're talking about a 2% drop. No, sorry. What am I getting wrong? So from 124 to 128 has grown 2%. But I guess year over year, the percentage has gone down. So we're going to look at cash flow real quick. It looks like they have pretty good cash flow. And people seem to like it. When I mean people, I mean in general. I just don't mean retail investors or institutions. I mean in general. It could be a mix of just everyone who's being involved in the investing process. So again, it could involve insiders, outsiders, such as retail traders and individuals, and everyone else, who likes to get involved, which is, investment banks and the such. So moving on to the next one. So Spirit of Texas, STXB. I think that's a stock that would rebound, to be honest. And again, you're not going to get a lot of capital gain, but I would say watch list. That's the stock to keep an eye out. So hats off to that one. Next up, I have BLX. Banco Latino Americano. So we have here market cap of 543. 52-week high of about 20, 52-week low of about 14, a difference of $6 for the year. That is a horrible gain. Showing me it's undervalued. Again, there are so many bank stocks, so far I'm going to say no. Dividend yield is high. Somewhat active for this stock. The 5 years you can see here, so we have about 26, dropping down to the year 2021 to about 16. So that is a drop and loss for the past 5 years. So an average about $10 loss. I can't tell you a percentage, but again, I go with dollar amounts. It's just easier for me. Percentages is, it's not as uh, it's not as exciting to hear, because anybody could say, "Oh yeah, you gained like 80%," but then you hear the dollar amount. When you hear the dollar amount, it makes a huge difference because again, the stock could be pretty cheap or expensive. If you gain 80% on, let's say, a $5 stock, it's like it's not much. So an analysis for this one. Also, these guys are not. Hold on. They're not an official bank, but let's look at the dividends real quick. So what I saw, so they made a cut. They made a dividend cut in 2020. As you can see here, that was a big cut. So now let's go all the way up here. Have they raised the dividend at all? They have not. So it looks like they're having issues. That tells me raising cash. I love to look at dividends, and I love it when companies pay dividends because you look at the history and you can kind of guesstimate more or less what's going on. And, if they're not raising dividends or cutting dividends, it's okay. I mean, it's in the middle. I mean, it's not bad and it's not good. But eventually you want to see them raise their dividends, even if it's by a penny. So it looks like they're just trying to readjust either strategy or management or something. But the generation of cash doesn't seem like it's there. So I'm going to say no. And again, the difference in price for the year, for the 52-week high and low, for this year, it's only like I said, a $6 difference. That is not much. That's actually awful. And what strikes me the most, these guys are a corporate financial services bank. So let's read a little bit about that. That's not too common for a similar sector. The other sector that I usually get is either consumer lending or banking services. Like they strictly, it's almost like a credit union. Like I said prior videos, it's like they operate as a bank, but they have certain limitations and certain types of loans that they can do. They're just more restricted when it comes to community banks or credit unions and the likes. So we have here, I just want to read about this because I think this is not common. This sector is not a common sector. So it says they're a multinational bank. They support the financing of trade and economic integration in Latin America and the Caribbean. Operates in two segments, commercial and treasury. So they do operate. So when I hear treasury, right away I'm thinking T-bills, and that has to do with more with corporate bonds. So they do incorporate a financing system that involves, I would assume, T-bills. So I would assume they get involved with bonds, is what I'm saying. So we have here, commercial segment incorporates all of the bank's financial intermediation and fees generated by commercial portfolio activities, such as origination of bilateral and syndicated credit, short-term and medium-term loans, acceptances, and contingent credits. Incorporates deposits in banks and all of the bank's trading assets, securities available for sale and held to maturity. So that is definitely the bond you know, the bond, how can I say, the bond process. But what do they serve? Okay, the bank serves a range of sectors, including oil and gas, agriculture, business, food and processing, manufacturing. Into three main areas: financial intermediation, business structuring and syndication, businesses, and treasury. So it looks like they specialize. Uh, it said commodities, which was the oil and gas. So they basically have a good business model, I would say. They are involved heavily in essential services. Oil and gas, it's essential. Agriculture, which is, has to do with food. And it also said, I was missing one more thing. So they also said with T-bills and then manufacturing. So that would have to be with the food also. So corporate financial services, that's what they fall under. Again, they have a good business model. It's just that they're not doing the right process. Something's just going on where or they're just not liked. I mean, 52-week high and low. I mean, market cap. Hopefully if they do good, hopefully they can raise the market cap. Maybe they get more noticed. And hopefully they can do what they keep doing. And I think they'll get more attention if they actually raise the dividend eventually. That'll definitely give it some strength and more eyes to look on this stock. So I'm going to say no for now. Hopefully in the future, who knows, they might do even better. So next up that I have is Wmpn, William Penn Bancorp. Right away I see it's flat. I don't like it. I can just tell right away. Difference of $2 for the year, 52-week high, as you can see, of 1288. I'm gonna round it off to 13. 52-week low of 1088. I'm gonna round that off to 11. You have a difference of 2. Sorry, I drew that line. I was trying to move my camera. So now we have the 5-year looking flat. The 1 year, I mean, it's starting to grow. If you look at it, it's starting to grow. Volume looks like it's picking up. I hope I'm wrong, but hopefully this stock becomes better at what they do. What is their debt is 73%. That is fairly low debt. And fairly low debt for a bank. They have 2019 a dividend payment of 40 cents, 2020 42. They did pay a special dividend, so it looks like they've been paying once a year, pretty consistent. But in 2022, they have paid only 3 cents. I still want to see this payment for the special dividend of 2021. Let's see what the amount is, if any. It is not showing me anything for the special dividend payment. So that can easily be looked up at NASDAQ. I don't have that information with me now, so I do apologize. But I still want to see. Let's look in for their yearly results. So I don't have any. I only have 2 earnings estimates for 2022, which is Q2 and Q3, because Q1, I don't have anything unless they met expectations here, but I don't see any dotted lines. I don't see anything there. So this is all kind of weird. You see, I have 2012, 2013, 2014 estimates, and then nothing for 2020, and it's jumped for 2021. This is kind of weird. It's a little inaccurate, so I'm not gonna go over this stock like I want to. But at least I have the debt percentage, which is pretty low compared to other banks. I'm gonna say no for now, but if they can, honestly, if they can keep their debt low and still be able to double the market cap, so I give it a few years, this stock can be a very, very sleeper type of stock. I can see this stock being a very good stock in the years to come if they manage their money correctly with that low of a debt. So let me look at something real quick. It's not showing me. So yeah, it's not showing me. So let's look at the next one. We have the next one, MVBF. So for the 1 year, it looks pretty flat. The 5 year, if we can see here from 2020 all the way to 2021, it has grown tremendously. So we have a difference of about, so round that off to 46. So we have a difference of about $13 for the year. It's not much. Could be better. But again, from 2020 to 2021, that's where this stock was pretty hot and popular. So we have here, they do pay dividends. It looks like it's undervalued. Let's move on and see the financials here. So we have here 2021 numbers. A debt of 90. That is really, really high. I don't like that. Let's look at the dividend payment. So we have 9 cents, 10 cents, and all that. I'm going to say no for this one. So this was MVBF. MVBF. Too much debt and the stock seems flat. That's all it is. The stock seems flat for this year. Moving on to the next one. BSRR, Sierra Bancorp. So, wow, they took a dip right here at around late March. So, let's look at the numbers, and it's only a difference of about $6. Looks undervalued. They do pay a dividend. Let's look at that, jump into that. So, we see here. So, we have a raise of 1 cent ever since 2020. So we have in 2021 a raise of 1 cent. Not a lot, but again, something's better than nothing. Any splits? They do not have any splits. So moving on, I'm going to say no. I'm not crazy about this stock. But let's look at so they are a bank. Let's look at the annual real quick. So they have grown. Let's jump in. So 89% debt. I saw that real quick. Any margins? No. The debt has remained the same. doesn't look like they want to lower the debt. I guess forever debt for some banking companies. So I'm going to say no to that one. Moving on to the next one, AMNB, American National Bank shares. So we have that. Not doing too bad for the 1 year, but the 5 year looks pretty flat. We have a difference of about $12 for the year, showing to me that it is undervalued. So we have here a 1 cent raise. So we have here 2021, 2020. So we have here pretty much the last 2 years have been about the same amount for the dividend payment for the last 2 years, at least. And the raise hasn't even been that good. The last split they had was in 1999, 2-for-1. So I'm going to say no right off the bat. And hopefully they do better next time. Next one up is OSBC, Old Second Bancorp Inc. So we have here, they're doing okay and flat for the last 5 years. The last year, they have these swings going up and down, so they look kind of flat. So we have here pretty active volume, $626 million market cap. They do pay dividends, positive earnings. It looks to me they're undervalued. I mean, this is a give and take kind of stock. I mean, you have these jumps up and down. So, I mean, it's hard to... so choppy. You see all these cuts here, you know? And it dropped. Then you have a bunch of... it's so volatile. So, if you want to stand through this pain of a stock... and again, as you can see for the 5 year, you know, this whole range here, this is only like a $3 range. So I'm going to avoid everybody the headache and say no. I know it's an active stock, but it's not even worth it. It's not worth the headache for a $3 gain. And then also for the dividend, you can find much better companies. Again, I hope I'm wrong. I hope this stock can actually jump up, you know. It went up and then looks flat. Then it dropped down slightly, but hopefully I'm wrong. And this stock can actually gain momentum and move past its 52-week high. I would say once it breaks after its 52-week high, that's when it would gain attraction. This would be an attractive stock right after it gains after its 52-week high, even though it has pretty good volume for a stock of its price and its market cap. So right now I'm going to say no, but again, I hope I'm wrong, and in the future, once it breaks its 52-week high, maybe it can gain some momentum and attention and attract investors. So next one up I have is Fibk, First Interstate Bank System. We have here 52-week high and low. 52-week high of 50, 52-week low of 34. That's a difference of $16 for the year. Not bad, but I think it could be better. As you can see, for the year, it has been going down. We have here like that downtrend. Then if I was to start right around there, downtrend, and it's just, yeah. This is a roller coaster that is dropping hard, and the volume is pretty active. So for this year, it seemed like, let's see. So for 2020, you rode the roller coaster. Then at about there, it dropped down, and that's already the more than halfway point. So we have here. So we're looking at the data at around March of 2021. So basically last year around this time, that's when it started to drop down, and the roller coaster ride is dropping, and it looks like it's coming to an end. So we have here 2020, the bottom of the roller coaster ride was about $27. And we're at 44 right now. So you subtract that 27. So we have, I'm going to round this off to 35 just to be generous. So we have about $8 left to go down. So that is not a high number, and as you can see from the chart, it's not looking good at all. And as you can see for the 5-year, let me go for the 5-year. Come on, why is it? I apologize for that. So let's look at the 5-year. Let's look at the 5-year, and right there, and again, like I said, it has an $8 gap to drop down to. So yeah, this stock is definitely a stock that people are jumping into short. They're betting short on this one. So it doesn't look like people like this stock. Last one up I have is Citizens Community Bancorp, CZWI, and let's finish this video. The 5-year looks awful. 52-week high and low. Market cap I don't like, even though it's undervalued. Again, not every undervalued stock is a good stock. For the year, it looks like they've been going up. But then, as you can see here, ever since February, they have gone down slowly. And that was the 52-week high, actually. So that was pretty much it. That summed it up for the company. It was only on a winning streak of maybe a few weeks. So as we can see here, they only have a payout of, let's start with 2015, of once a year. As you can see, 2015, 16, 17, so once a year. And they started to cut. Let's see if they made any dividend cuts. So since 2015, it's gone up, 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 stayed the same. It has gone up, and gone up. So that's good. It has not cut the dividend. But again, if you want to have a once a year payout, I don't really like those infrequencies. I mean, one time a year payout, that's not really. If it's a new company or if it's a really low market cap, if you can withstand that getting paid once a year, it's fine. It might grow, and it's way better managed that way when you're doing once a year, and especially when they're growing the dividend. But unfortunately, this stock has only gained a little bit of momentum, and this was only for the past few weeks, and then it's dropped down. So I feel bad for this company and the stock. Maybe they did have good numbers, and people just wanted to short it just to make money. So what I'm saying is, maybe some people fundamentally believed in it, but then it starts to go up, and then it just kind of attracted institutional investors and a lot of rich people to short the stock and just kind of profit off of it and take a quick profit and get off the roller coaster ride, as I say. So we can hear 90% debt, and we have here they have beaten earnings. It looks like they have beaten earnings, and they're growing their earnings. So you can't count these guys out. You can't. I mean, they had some good momentum. Even if it was for a few weeks, they still had that good momentum. So that shows that they were doing something good. Even though it's dropping now, this still shows that they still have something good. So they have beaten earnings by a lot. That's definitely good. even though Wall Street likes to react randomly based on the overall stock market. But we have here, let's see, it looks like earnings have grown, assets have grown, equity has grown. Sometimes I do have data for the data on the net margin. Sometimes I do, sometimes I don't. I don't have it. The debt they have to start lowering. I mean, it's okay to have debt. And again, that's typical, 90% for banks. But again, for me, my opinion, I need to see that debt drop, especially for fundamental reasons if people want to invest long term. So all in all, I would say watch list. I would say watch list. This looks like a company that has been growing pretty fast. Pretty fast. And it looks like they're doing pretty good, actually. So I want to take a look at their cash flow. They're having cash flow issues, but they're beating earnings. So again, with the banking sector as of right now, they're in favor for interest rates. So again, CZWI, I'm gonna say watch list. They have some momentum, so who knows? It might come back to them, and hopefully they'll gain some price momentum and all that. So I know this video took too long. It takes me a few minutes to evaluate these companies, probably about 5 minutes each. But again, thank you guys for watching. If you don't want to watch the full video, and you could always fast forward this. And again, I suggest if you want to listen to this video or look at it, you don't even have to look at me. You could just listen to it. Hopefully, that's still a good insight for you while you're in your car or you're doing something else or multitasking. Again, like, subscribe, and just put this on a 1.5 speed. I don't want to waste your time. I know my videos are long, but yeah, put this on a 1.5 speed. Speed up this process. Hope you enjoyed the video and see my perspective as to what stocks may seem good, what may not seem good, and again, hope you learned something. Hope you enjoyed it. Hope you liked it. So I'll see you guys in the next one. I'm going to make a video right after this one. I'll try to continue this tomorrow. And let's try to finish this sector up. It's a long sector. So have a good weekend, guys. I'll see you very soon. And thanks for dropping by.